In March 2009, a school teacher in Ohio put $50,000 into a simple S&P 500 index fund, not a hedge fund, not a hot stock tip, a basic index fund bought at the exact moment every financial news channel was predicting a second Great Depression. By 2024, that position was worth just under $600,000. So what did she see that everyone else missed? Here's the thing. She probably didn't see anything that most people couldn't. What she had was a framework for understanding what kind of moment she was standing in. And right now, in 2026, a very similar kind of moment is forming, except this one is larger, slower, and almost invisible, unless you know where to look. This video is going to walk you through two specific forces that are colliding at the same time. One is demographic, one is technological. Together, they are going to redirect more capital than any event in modern financial history. And understanding how that redirection works changes how you read almost every financial decision in front of you. You probably feel like you're doing the right things, saving consistently, contributing to your retirement accounts, maybe investing in index funds, and that logic is sound. The problem is that doing the right things during a normal period and doing the right things during a structural shift are not the same calculation. And the window between those two situations is where most people quietly lose ground without ever understanding why. Once you see what's actually moving, the surface level noise stops being confusing. My name is Alex, and if you've ever watched the market climb for years and still felt like your own financial picture wasn't keeping pace, stay with me, because the gap between those two things has a specific explanation, and I'm going to show you exactly what's driving it. It starts with a pattern that history has repeated before. Here is what almost nobody talks about when they tell the story of 2008. It is not the crash. The crash is well documented. What gets skipped is the 18 months that followed it, and what was quietly available to anyone paying attention. By early 2009, the S&P 500 had lost roughly 57% of its value from its 2007 peak. Unemployment was climbing toward 10%. Major banks had needed government bailouts to survive, and the financial press was running headlines about the end of American capitalism. And in that environment, with all of that noise, a school teacher in Ohio moved $50,000 she had saved for a house down payment into a basic index fund, not because she had a Wall Street contact, not because she had access to information nobody else had. She made that move because she understood one simple thing. Fear and risk are not the same. When fear is at its highest, like the actual price you pay for assets is at its lowest, those two facts exist at the same time, and most people only feel the first one. What happened next is the part worth sitting with. The market did not just recover. It went on the longest bull run in American history. From March 2009 through February 2020, the S&P 500 climbed roughly 530%. That $50,000, left alone and compounding through that entire run, grew to just under $600,000. And she did not time the market perfectly on the way out. She did not need to. The entry point did most of the work. Now you might be thinking, well, that was a once-in-a-generation event. And you're right, it was. But here is what that framing misses. Once-in-a-generation events have a habit of arriving once per generation. The question is not whether they happen. The question is whether you recognize one when you're standing inside it. Between 2010 and 2024, the United States created 15.6 million new millionaire households. That number sounds like it belongs to a different world than most people live in. But when researchers broke down who those households actually were, the picture looked different than expected. They were not predominantly finance professionals or tech founders. The vast majority were nurses, engineers, small business owners, and teachers. People who started putting money into index funds and retirement accounts in 2009 and 2010 held through every scary headline that followed and simply did not stop. Consistency did more work than genius in almost every one of those cases. That is not an inspirational point. It is a mechanical one. Compounding requires time above everything else. Interrupt it, and you reset the clock. Let it run, and the math eventually becomes difficult to believe. Warren Buffett said something in 2009 that captures the whole dynamic in one sentence. He said that the best opportunities do not arrive when everything feels optimistic and safe. They are born in moments of maximum pessimism, when the crowd is moving in the opposite direction. That is not a contrarian philosophy for its own sake. It is just an observation about how asset prices work. When sentiment is negative, prices fall below what the underlying value justifies. When sentiment recovers, Prices reflect that value again. The gap between those 2 points is where returns come from. Most people understand this in theory. Almost nobody acts on it in practice, because acting on it requires sitting with discomfort that feels genuinely dangerous at the time. In March 2009, buying an index fund did not feel like a reasonable financial decision. It felt like catching a falling knife. The people who did it anyway were not fearless. And they were just willing to separate the emotional signal from the financial reality underneath it. So that is the 2009 blueprint. Understand the moment. Know what fear actually represents in pricing terms. Act when others are frozen. Then hold long enough for the math to do its job. And here is where the conversation shifts. Because the opportunity sitting in front of us right now is not a market crash. There is no single dramatic event to point at, no obvious bottom to buy. And what is forming instead is something slower, more structural, and in some ways harder to see clearly. The kind of shift that looks obvious in hindsight and invisible in the present. It is being driven by two forces operating at the same time. Each one would be significant on its own. Together, they are creating a redirection of capital at a scale that has no real historical precedent. The first force is purely demographic, and it is already underway. The second is technological, and it is accelerating faster than most people have adjusted for. To understand why both of these matter, and why their timing together is the key detail, you have to start with the money, specifically where it currently sits, whose hands it is in, and what is about to happen to it. Because $124 trillion is about to change direction, and the path it takes is going to reshape entire industries along the way. Think about what it actually means when a river changes course. The water does not disappear. It does not slow down. It just stops going where it used to go and starts going somewhere else entirely. And everything downstream from the old path dries up, while everything along the new path gets flooded with more than it has ever seen before. That is the most accurate way to describe what is happening right now with American wealth. Here is the number: $124 trillion. And that is the estimated total value of assets currently held by baby boomers and the silent generation in the United States: real estate, brokerage accounts, retirement funds, private businesses. Over the next 20 years, every dollar of it is going to move. Some through inheritance, some through gifts made during their lifetimes, some through the sale of businesses and properties. But it is all moving, and it is all moving in the same direction, downward, to their children and grandchildren. And to put that number in context, $124 trillion is larger than the entire annual economic output of every country on Earth combined. It is not a financial event. It is more like a geological one. Slow, structural, and permanent. Right now, roughly $78 trillion of that total sits with baby boomers alone. That generation built its wealth through a specific set of conditions: low starting home prices relative to income, defined benefit pension plans, and decades of equity market appreciation, and a financial services industry built almost entirely around their preferences: blue chip stocks, municipal bonds, dividend-paying funds, the classic balanced portfolio that your parents' financial advisor still probably recommends. That model worked for the people it was designed for, but the people receiving this money did not grow up in the same conditions and do not share the same instincts. Here is where it gets interesting. Multiple large-scale surveys of high-net-worth investors under 45 consistently show the same pattern. Younger inheritors are not moving money into the same assets their parents held. They are allocating toward what they actually understand and believe in: technology infrastructure, renewable energy, private equity in early-stage companies, and increasingly into the specific platforms and ecosystems they already use every day. They are not abandoning equities. They are redirecting which equities they trust and why. Now, you might push back here and say, people have always invested differently from their parents. That is true. But the scale of what is moving makes this different in kind, not just in degree. When you redirect even 5% of $78 trillion into a new category of assets, that is $3.9 trillion flowing somewhere it was not flowing before. That moves markets. It creates new winners. It starves old ones of the capital they relied on. Think about what happened to certain retail and media stocks in the 2000s. They did not collapse because their businesses suddenly became worthless. They collapsed because the next generation of capital allocators did not see them as the future and stopped buying. Capital withdrawal is quiet at first. Then it is not. The same mechanism is about to play out across a much wider range of industries, at a much larger scale, driven by a transfer of wealth that is not a prediction. It is already happening. The Federal Reserve's survey of consumer finances shows intergenerational transfers have been accelerating since 2020, as older boomers entered their late 70s and early 80s. This is not something that is coming, it is something that is underway. And here is the part that tends to get overlooked in conversations about the wealth transfer. It is not just about which assets get bought, and it is about which financial behaviors become normal. Younger inheritors tend to be more comfortable with volatility, more willing to hold concentrated positions in sectors they believe in, less attached to the quarterly dividend as a signal of safety. Those behavioral differences, multiplied across trillions of dollars in motion, produce a very different market environment than the one we have been operating in for the past 40 years. So if you have been wondering why certain sectors feel like they are getting disproportionate attention and capital, while others that used to be considered safe feel like they are slowly losing momentum, this is a significant part of the explanation. It is not irrational exuberance or a bubble in the traditional sense. It is a structural reallocation driven by a generational handoff that has been mathematically inevitable for decades. The wealth transfer alone would be enough to reshape the financial landscape in meaningful ways. But it is not operating in isolation. It is colliding with something else, something that is moving even faster, and compressing the timeline on all of this in ways that are genuinely difficult to fully account for. Because at the exact same moment that this river of capital is changing course, a second force is accelerating alongside it, one that is not about demographics or inheritance at all. It is about the speed at which entirely new industries are being born, and how quickly capital is learning to find them. That is the part of this story that most people have not fully connected yet. There is a specific number that stops most people cold when they first hear it, not because it is large, but because of what it implies about speed. Netflix launched its streaming service in 2007. It took 3.5 years to reach 1 million users. Facebook launched in 2004 and hit 1 million users in about 10 months. Those were considered extraordinary adoption curves at the time. Industry analysts wrote papers about them. And ChatGPT launched in November 2022 and reached 1 million users in 5 days. Same milestone. 5 days versus 3.5 years. That is not an incremental improvement in how fast technology spreads. That is a different category of event entirely. And the reason that number matters for this conversation is not about ChatGPT specifically. It is about what accelerating adoption speed does to the economic timeline. When a technology takes a decade to reach scale, industries have time to adjust. Incumbents can adapt. Capital can reposition gradually. When a technology reaches scale in months, the economic consequences arrive before most people have even decided how they feel about it. That compression is what makes this moment different from previous technology waves. The internet changed everything, but it took roughly 15 years to fully reshape the economy. Smartphones took about 10. AI is not going to take 10 years. And the infrastructure is already built. The distribution channels already exist. The capital is already moving. The only variable is how quickly the applications mature. And that clock is running faster than most people have adjusted for. Now, here is the important distinction to understand, because this is where a lot of conversations about AI go sideways. What most people are interacting with today, the chatbots, the image generators, the writing assistants, is genuinely useful. But in the broader arc of what this technology is becoming, it is closer to the beginning than the middle. What researchers and the major technology companies are actually racing toward is something categorically different. It is called artificial general intelligence, or AGI. And the gap between what exists today and what AGI represents is not a gap in degree. It is a gap in kind. Today's AI can help you draft a business plan. It can summarize a contract, and it can write code for a specific function if you describe it clearly. AG, I would not help you build a business. It would build the business, research the market, identify the opportunity, write the software, handle the logistics, and adapt in real time as conditions change. The human role in that scenario shifts from operator to decision maker at the highest level, with an autonomous system handling the execution below. Whether that arrives in 5 years or 15 is genuinely uncertain. What is not uncertain is the direction. Every major technology company in the world is allocating its largest capital expenditures toward this goal right now. Microsoft, Google, Amazon, Meta. They are not doing that because AGI is a distant theoretical possibility. They are doing it because they believe it is an engineering problem with a solution, and the first company to solve it controls something close to an unlimited economic advantage. So the gold rush is real. If the question is how you think about positioning yourself relative to it. Here is where most people make the same mistake. They try to identify the winner. Which company is going to build the dominant AI platform? Which stock is going to be the next NVIDIA? And that is a reasonable instinct, but it carries enormous concentration risk. Picking the right company in a fast-moving technology race is genuinely difficult. The history of technology is full of companies that led early and lost later. It's MySpace before Facebook, BlackBerry before iPhone, Alta Vista before Google. Being first is not the same as winning. The more reliable framework has a different starting point. Instead of asking who wins the race, ask what every competitor in the race unconditionally needs in order to compete. In the original California gold rush of 1849, the people who made consistent fortunes were not usually the miners. They were the merchants selling picks, shovels, denim work pants, and provisions to every miner, regardless of whether that miner found gold. The demand for their products was not contingent on any individual outcome. It was contingent only on the race continuing. And the race always continues. The modern equivalent of that position sits in the infrastructure layer underneath AI. Every company building AI applications needs cloud computing capacity to run them. Every model being trained requires data centers, and the physical buildings filled with specialized hardware that process and store the information at scale. Every system handling sensitive data requires a cybersecurity architecture around it, and all of it, every layer of this entire ecosystem, runs on semiconductors, the chips that do the actual computation. These are not speculative bets on which AI application will win the market. They are positions in the substrate that the entire competition depends on. When capital pours into a race, the infrastructure that race requires tends to see demand that is both large and durable, regardless of which individual competitors succeed or fail. That is the picks and shovels position, and it matters more in this particular moment than it would in a slower-moving technological transition, because the wealth transfer happening simultaneously is actively looking for exactly these kinds of opportunities to deploy into. Two forces, same direction, same timeline. The next question is what you actually do with that. There is a version of this conversation that ends with a list of stock tickers and a confident prediction about which ones will double in the next 3 years. That version is more satisfying in the short term. It is also the version most likely to cost you money, because the honest answer to the question of what you do with all of this is more structural than that. It is less about which specific assets you buy and more about how you think about the sequence. Get the sequence wrong, and even the right assets in the wrong order can set you back. Get it right, and you give the compounding math enough room to actually do its job. So let's walk through the framework. And to be clear about what this is, it is an educational model for thinking about positioning during a structural shift. It is not financial advice. Your specific situation, your income, your tax picture, your existing accounts, all of that matters in ways that a general framework cannot fully account for. Talk to a fee-only financial advisor before making significant moves. What this is designed to do is give you a clear mental model so that when you do have those conversations, you are not walking in blind. The foundation comes first, always. This does not change regardless of what is happening in the broader economy, and it does not get more interesting just because there is a compelling macro story sitting above it. Max out your tax-advantaged accounts. Your 401k, that is your employer-sponsored retirement account, and your IRA, your individual retirement account, exists specifically to let your investments compound without being eroded by taxes every year. The difference between a taxable account and a tax-advantaged one over a 30-year horizon is not small. Run the math on $100,000 growing at 7% annually for 30 years in a taxable account versus a Roth IRA, and the gap can exceed $200,000. That gap is not from better investments. It is purely from the tax treatment. Skipping this layer to chase a more exciting opportunity above it is one of the most expensive mistakes a person can make. Alongside that, own the whole market through simple index funds. A low-cost total market index fund gives you exposure to the entire U.S. economy in a single position. When a new sector rises, you already own it. When an old one fades, your exposure shrinks automatically. You do not need to predict which companies win. You just need the overall economy to grow over time, which over any 30-year period in American history it has. This is the boring layer. It is also the one that has quietly made more ordinary people wealthy than any other approach. Get that foundation right first. Then, and only then, does it make sense to think about what sits above it. Like the second layer is about understanding where capital is flowing and positioning yourself in the infrastructure that the flow depends on. This is the picks and shovels idea applied practically. Cloud computing, data centers, cybersecurity, and semiconductors are not exciting in the way that a single AI company with a breakthrough product announcement is exciting. They do not generate the same headlines, but they have a structural characteristic that the headline grabbers often do not. Their revenue is not contingent on any single application winning. It is contingent on the overall ecosystem expanding. And the overall ecosystem is expanding regardless of which individual companies come out on top. Now, how you access that layer matters. For most people, it is not through picking individual stocks in these sectors. The research requirement is significant, and the concentration risk is real. Sector-focused index funds, or ETFs, that is exchange-traded funds, give you exposure to an entire category without betting your outcome on a single company's execution. You participate in the infrastructure growth without needing to correctly identify the specific winner in advance. The third layer is behavioral, and it is the one that undoes people most often. You have to think in decades, not in months. This sounds obvious until you're watching a position you hold drop 20% over 6 weeks, while every financial headline is explaining why the trend is over. In that moment, the decade-long frame is very hard to hold onto. But it is the only frame that lets compounding work at the scale that actually changes your financial picture. Related to that, hold cash with intention, not as a permanent strategy. Cash loses purchasing power to inflation over time. Sitting entirely in cash is its own kind of risk, but maintaining a meaningful cash reserve gives you something that has real strategic value during a structural shift. It gives you the ability to act when prices dislocate. The school teacher in Ohio in 2009 could only buy that index fund because she had the $50,000 available when the opportunity appeared. Opportunity without capital is just observation. So the sequence is this: maximize the tax-advantaged foundation. Add infrastructure exposure through diversified vehicles. Hold the long-term frame regardless of short-term noise. Keep enough liquidity to move when conditions create an opening. That is not a complicated framework. But simple and easy are different things. The difficulty is never in understanding the structure. It is in maintaining it through the periods when everything around you is suggesting you abandon it. And that brings us back to where this whole conversation started. Here's the thing that ties all of this together. The people who built real wealth coming out of 2009 were not smarter than everyone else. They were not better informed. They just had a framework for understanding what kind of moment they were in. And they acted on it while everyone else was waiting for the feeling of safety that never arrives before the opportunity closes. The same dynamic is running right now. The wealth transfer is not a forecast. The technology acceleration is not a theory. And both are measurable, documented, and already in motion. The window is open. It will not stay open indefinitely. 3 things determine the outcome more than anything else: whether you protect your foundation before chasing the opportunity above it, whether you think in decades when everything around you is thinking in weeks, and whether you have capital available when the moment actually arrives. What is worth sitting with is this: and every structural shift in economic history has produced a generation of people who positioned early and a generation who understood it perfectly in hindsight. The information available to both groups was nearly identical. The difference was always what they decided to do while the window was still open.